Joining us now is the analyst behind that call, Deutsche's Joe Ahlersmeyer. He's a research analyst along with Skylar, Olsen, chief economist at Zillow. Welcome to both of you. Joe, I'll start with you so you can maybe correct your last name for me. But in all seriousness, the homebuilders have been on a great run. What powers them from here?
Sure, and it's Joe Ahlersmeyer. Appreciate that, Kelly. It's nice to be here. And like you said, we initiated coverage on the home builders last night. The report was titled Rise of the Machines, and maybe it's all the discussion lately about AI that had us thinking about Terminator, but really this report was about how the public home builders have a business model built around generating targeted returns on investment and have also had a lot of success scaling their business on a national and local level. So even in softer markets overall, but especially in stable and stronger markets, these companies can gain share within the industry, but also demonstrate more resilience relative to the overall housing market.
Before I bring in Skylar, why is it that Lennar and NVR would be a couple names that you actually have sell ratings on?
Sure. So when we think about our framework, really what we're trying to do is think about who has the best return on inventory prospects and who's going to grow book value. So we do expect Lennar to deliver 20% more homes next year than in 2019, and with similar margins and at higher prices. No question they're in a better absolute position as a company than they were before the pandemic. But why the sell rating? The valuation framework that we're applying really values higher returns on inventory better. And we expect to also see better growth at peers like D.R. Horton and Meritage. Community count is lower at Lennar than before the pandemic. Starts in the last couple of quarters really still haven't ramped like they have at Horton. We'll see if that changes when they report in a few weeks. But in our view, growth is just going to be a little bit slower at Lennar in the near term, and returns are going to drift back down a little bit.
Skylar, what have 7% mortgage rates done to the market generally? And in what parts of the country are houses still appreciating at sort of above trend rates, and in what areas may they be slipping backward just a bit?
Yeah, absolutely. I mean, mortgage rates mean a lot for the housing market right now. I think we're in so many ways driven by those mortgage rates. And to think about what's happening to prices right now, I think it's really important or more intuitive to think not as mortgage rates as a buyer problem, which it absolutely is. The problem is that 70% of an existing seller, so an existing homeowner that might sell an existing home, so not those new construction homes, 70% of them are also buyers. So we've seen a dramatic pullback in the number of new listings that has returned home value appreciation almost across the country, even those kind of harder hit and more expensive Western markets. Some of them have drifted back to the top of the market in terms of the fastest appreciators. But otherwise, we're seeing still a lot more interest in homes in, say, the Midwest, where affordability is still an option, at least relative to other places, despite high mortgage rates. But more than that, it's places like, the Midwest and the South that were drawing so much migration even pre-pandemic. And we saw that continue throughout the pandemic, and a lot of interest and pressure in those kind of areas.
So, Skylar, the question, I guess, is, we could ask about the housing market itself, but we all are a little familiar with the dynamics right now. I wonder if for the broader economy, do we interpret this as, price pressures going back and putting upward pressure on inflation, or, should we be really looking at inflation ex shelter for the time being?
Yeah, I think, when we think about just the crystal ball in it and looking forward, the mortgage rates have lifted, I think, in many ways from two things, right? That PCE showing of core inflation just coming in more than expected. So, continues to have general inflation. And if we look at our rental numbers, we're also starting to see some pressure come back up on rent, still softer than pre-pandemic. And here I am talking about those asking rents and not just the full, releases that the Fed is also very concerned about. So there we see still continued pressure on inflation. And I don't know the market is wildly confident, or rather the Fed is wildly confident that inflation will come down very quickly here. So I think expecting, yes, continued upward pressure on mortgage rates, maybe not up to 7%. We did see in the last couple of days it come down. That might have been a bit of risk from the debt ceiling as well. That might have a little bit of room to come back down still a bit, but I wouldn't expect a lot of relief. We still have to get to the other side of our inflation challenge. And I think what we've learned over the past couple of weeks is that's recovery is being pushed out.
All right.